New friends, new opportunities, new partners. EG Tax.
And here's Esther.
Okay, everybody, I'll tell you what we're doing here is this is the individual tax portion of the presentation, okay? All right, so Tiffany and Christopher are my right-hand guys. Chris is our vice president in charge of tax operations. Tiffany's vice president in charge of marketing and corporate development. So they're going to start off with the individual portion. After lunch, I'm going to be doing business tax reform. So if you want to come back, I'll be teaching that after lunch. And I just want to thank you for coming. All right, Tiff?
Okay. So we have put together a PowerPoint so you can follow along on the screen in front of you. Also, we put together slides in the book. So you guys have all heard in the news the most sweeping tax reform was just passed since the Reagan tax changes, right? And say what you will, I think I've discovered, talking to my clients, about 1/3 of my clients will save money, 1/3 will lose money, and 1/3 will stay about flat. So Chris and I, we're going to split the presentation and we're going to talk about the tax reform and how it affects individuals. And it's just really, I've been doing taxes for 18, 19 years, and it's just mind-boggling the change that's in front of us. And I think the real losers are people who are W-2 employees and have business expenses. Those are the real losers in my impression. So let's start off with a slide that says the tax cuts, which sort of leads to what I was saying, and it's the most sweeping tax change that we've ever seen. And the idea was that it also lowered the tax rate, which is really, really exciting. So a lot of people who don't itemize are really going to find an advantage. When I'm talking to a lot of my clients, and we'll show you examples in a little while, because they did away with some items and increased the standard deduction, the tax rate simultaneously reduced. And so the idea was to put more money into the pockets of middle Americans, which is really exciting. So you can see what was in 2017 and what is in 2018. And so we now have the 15% tax bracket dropping to 12%. We now have the 25 dropping to 22. We now have the 28% tax bracket dropping to 24. And that's down the line for single, head of household, married. So you can see that the tax rates have really dropped, which is really, really, really beneficial. I think a lot of my clients, the lowering of the tax brackets has been huge. So even some people that were thinking about taking a larger distribution from their 401k or their IRA, it was more beneficial to take the money out in 2018 because of the reduction in the tax brackets. So that's really exciting, really exciting. Under the law, there are numerous changes to the individual income tax return, including the income level of the brackets, which I showed you in the previous slide, lowering the rates and increasing the standard deduction and family credits. And there's changes in itemized deductions and the personal exemptions. You guys have heard this over and over and over and over again in the news, that the personal exemptions are gone, which is really unbelievable. But the personal exemptions are gone, and that's because they increased the standard deduction. They doubled it, and so the personal exemptions are absolutely gone. And so that is a really big highlight. And this sort of emphasizes what I said. The standard deduction, if you were married, it's going from $12,700 to $24,000. For a single filer, it's going from $6,350 to $12,000. And if you're over the age of 65, don't forget you get an extra $1,500 $500. So you still get that extra $1,500 on top of the increased standard deduction. So if you're single, $12,000, over 65, you're going to get $13,500. Unmarried individuals with at least one qualifying child, which would mean head of household, their new standard deduction is $18,000. And then, as I said a minute ago, you could just take a big X and put it right through the personal exemption, because those are gone. So if you're breathing and living, you no longer get that personal exemption. It is hasta la vista, baby. And here is an example. So the old law, we had Rick and Heather. They have 2 children, 9 and 12. Rick and Heather made $135,000. They own a home and they itemized their deductions. Their itemized deductions are $18,795. Their personal exemptions collectively for 4 are $16,200, yielding a tax of $16,434. They received child tax credit of $750. It was supposed to be $1,000 a child, which was $2,000, but under the old law, the child tax credits went away very easily, and so their income was so high that they weren't getting the full child tax credit. So that brings their tax bill down to $15,684. They withheld $18,000. They're going to see a refund of $2,316. And the new law, Rick and Heather, same as above, with the same earnings, but the new law, they will not itemize because their new standard deduction is $24,000, and so their itemized deductions under the old law was $18,795. So that means they don't have enough to itemize. They will not receive any personal exemptions. They will, however, have a lower tax bill. Remember, I showed you that a few slides back. And so that will roughly be $18,407, but their child tax credit, ta-da, is going to be $4,000 instead of $750, because the new threshold for losing the child tax credit is like $400,000. So that's a huge change. So I want to reiterate this. Instead of getting $750 for their 2 kids, they're going to get $4,000. That's huge. So that's going to reduce their tax bill to $14,407. Remember, they withheld $18,000, so their refund in their hand is $3,523. So as I put vertically, they're going to be a winner under the new law. And a lot of reasons that they're a winner is the reduced tax rate and the increased child tax credit is now not $1,000 but $2,000, and then also the chances of getting it are higher. Remember, under the old law, it started phasing away when your income reached about $110,000. New law, it won't be gone until about $400,000. So those are reasons that they are winners under the new law. And here's a loser under the new law. And then I'm going to turn it over to Chris. So we have the same couple, but their kids have grown up. Now their kids are 17 and 21. They're both in college. Rick and Heather make $135,000. They own a house. Their deductions, remember, are $18,795. Personal exemptions, 4 of them, are $16,200, yielding the tax bill of $16,434. They receive no child tax credit because, remember, if the kids are over the age of 17, that hasn't changed. They don't get any child tax credit. However, they have college credits of $3,000. This brings their bill to $13,479. Remember, they withheld $18,000. They get $4,521. New law, Rick and Heather, well, their kids have grown up. Now the kids are, we know, they made $135,000. This year they'll take the standard because, remember, it's $24,000. It beats their itemized deductions, so they're going to take the standard. No personal exemptions because, remember, I told you those are slashed. They will, however, have a lower tax bill because of the reduced rates. That'll roughly be $18,477. They will have that college credit of $3,000, reducing the bill to $15,400. And they will also have, this is new this year, there's a $500 family credit. So if you have kids over the age of 17, you no longer get a personal exemption for them, but you get a $500 family credit, yielding 500 times 2, 1,000. Now their bill is $14,477. They withheld $18,000. Their refund is $3,523. So the difference under this law is they have lost their personal exemptions. They don't get that whopping child tax credit of $2,000 a child, and they aren't able to itemize. So you can see the picture here. If you don't get that whopping child tax credit of $2,000 a child, that can be really detrimental to you. That child tax credit, which used to be $1,000, is now $2,000, and now it's being phased out not very often. So people who have kids under the age of 17 are like, thumbs up, good stuff. Okay, Chris?
But over 17 or older, bad news.
Right.
Tiffany, can I just say,
Yeah.
$3,000 credit for college, it's $1,500 per student.
Yes, yes, and actually, it really would be the American Opportunity Tax Credit, and really, it would be $2,500 per student if it's the American Opportunity. In that example, it was the lifetime. The American Opportunity Tax Credit is even better. It's $2,500 a student. So in that example, it would have been $5,000. But in that example, I did lifetime learning, which is not as good as American Opportunity. American Opportunity is up to $2,500 per student, and that's really, really good. That has not changed under the tax reform. The college credits have not changed. Yeah.
Chris, why did you mention that on the state of New York,
Give it to your mother.
on the state of New York, even though you can't itemize on the federal, you can possibly on New York?
The debuckling? Yeah.
Not debuckling.
Well, debuckling, whatever. Even though it is New York State, we got to watch what we say. Yeah, so what Esther was saying, New York State is trying to decouple themselves from the IRS. Old law was whatever the IRS says and you do on that return, you do over here. So if you itemize on the federal, you can itemize on the state. If you take the standard deduction on the federal, you have to take the standard deduction on the state. Well, New York State, because we do live in one of the highest tax states out there, finally realized, wow, our residents are going to be in trouble. So what they're trying to do is figure out how they can make it possible that if you take the standard deduction on the federal, you can still take all those expenses that you were able to itemize on for the federal, but you can't anymore, to be able to do it on the state. So where the $10,000 cap is on your property taxes, that may be gone for New York State. The business expenses that people can't write off on the federal anymore, maybe they're on New York State. What's really bizarre, it's now October 13th, right? New York State has no clue what they're doing yet. They're all ideas. So we gotta be, pay attention to the news. Call, if you hear anything, call us on the phone. Listen to our radio show. That's why we do this. We want to keep everybody out, whether you're our client or not. We want to keep you educated on what's going on so you get the best answer on your tax return. Okay?
So that's crazy. I would never, ever since I've done tax returns, would you take the standard on the federal, but itemize on
You could never.
But that's what they're proposing now.
Right.
Yep. And going off of what Esther said prior to with your minimum distributions, we see a lot of seniors who don't take advantage of taking out more money than they have to from their IRAs or their 401ks. What we mean by that is people, all I have to do is take out $4,000, and that's all they take out, and their only other income is Social Security. So they don't have to file a return. Well, the truth is, what's their new standard deduction? It's 12,000, right? Plus the extra 1,500, that's 13,500. Their Social Security, if they take out $13,500, isn't going to be taxable, and their standard deduction will wipe out that total distribution. So they're not going to pay, just because they have to only take out 4,000 doesn't mean that's what they should take out. They could take out over that, pay no tax, and then their beneficiaries later on, because it's in a checking account or a savings account, will inherit that money tax-free. Because if I inherit my mom's pension or IRA, I have to pay tax on it. So if she can take more money out now and pay no tax, it's a win-win. It's a win for her because she's not paying tax. It's a win for me because I'm not paying tax. And who loses? The IRS. And is that a bad thing?
Just repeat that again. Make sure that they understand what you're talking about.
Okay. So, you know,
You guys understand what Chris is saying? Okay. In other words, just because you have to take it out, take out the minimum, you can take out more than the minimum and still not pay taxes. So why wouldn't you take more out? You know, and deplete your IRA, put it in another investment, and you don't pay taxes, and your kids, when they inherit it, they don't pay taxes, right? So take out more if it's going to be tax-free.
right?
And then when we do our taxes, we can find out just how much we could take.
Exactly.
Well, but
give us
you have till December the 31st, so go see us in the back. We'll tell you how much you can take out.
Yep, give us a
Or
call.
call us on Monday. We'll look at your tax return.
We do
We'll tell you what you can take out.
consultations year-round for people, no charge, and this is what we do.
In other words, it's a way to skin the cat, right? I'm not going to talk anymore. I'm sorry.
No, that's to be my guest. Okay. So personal residences, this is very interesting, okay? When we already said the $10,000, well, I said that before, but the slide's coming up. The property taxes in your state withholdings limited to $10,000. What this slide is referring to is mortgage interest, okay? I know it's not gonna affect a lot of people in this room, okay, because how reasonable our cost of our houses are, but what the IRS is doing is if you buy a house, well, old law was more than $1 million, you can only write off interest up to that $1 million. Okay, so if you bought a $2 million house, that's what your loan was for? John's in trouble. Oh, you could only take off half of that interest. So if your interest was $40,000 on that $2 million home, you could only use $20,000 as a write-off, okay? So now what they did is they brought that $1 million cap down to $750,000, okay? So like I said, that part of it isn't really gonna impact a lot of people in this area, but it may. You may know somebody.
So my $2 million house is I can't.
Your $2 million house. Okay. Our receptionist said yesterday, my daughter said you're rich because you have a St. Bernard. So there's that aspect of it, but the big part is, now this part will impact everybody. Interest from home equity loans, AKA second mortgages, will no longer be deductible unless the money is used for home improvements. Okay? I know in years past, we used to tell parents, take out a home equity loan, pay off your kids' student loans, then let the kids pay you back. At least the interest will be deductible. Can't do that anymore. Can't take a home equity loan out, well, you can, but you can't deduct the interest to pay off credit cards. Okay? The government is going to crack down on second loans on houses. We don't know if it's just going to be hey, Esther, please send us proof what you did with your $80,000 second loan.
Right.
You know, and then you got to show, well, here's the plumber, here's the, you know, the electrician and the carpenter. You know, we don't know how that's going to work, but we were told, we just all went to a seminar in Atlantic City, and we were told this is one of the areas they're going to crack down on. And we actually, on our website, we do have a worksheet to help you calculate out how much of your interest would be deductible if you did do that. Okay, yes. If you don't itemize, it's moot.
Unless you're itemizing on New York State.
That's true.
Okay.
Yes. Yes. Her question is, and I'm doing this too for people over there and on the camera, what if you already have one now like that? Nope. No, we were told it, even if you took the loan out in 1999, you should have all your records with what you did because they could.
Really good question. That was a really good question.
Yep.
We asked that question too.
So you gotta be careful. I mean, I know my mother, I'm nothing like her. She has receipts from day one of what she did to her house, and she built her house in 1964. Okay, I don't have those receipts, but I gotta start keeping them if we were to take out a second loan out on our house. Because you just don't know, you know, gotta be careful. And credit card statements aren't good enough anymore for the IRS. You have to have the actual receipts.
That was a stinker. I found that out for the clients.
Yep. Okay. Salt. Doesn't mean the seasoning we put on our meat, okay? That's state and local taxes. They capped that part of the Schedule A to $10,000, okay? Where you're able to write off your state withholding, your state estimates, your sales tax. If you bought a car, a boat, an RV, that sales tax used to be deductible, okay? And 100%. So if that came to $25,000, you would be able to write off $25,000 on your federal. It is now capped at $10,000.
Chris, and I know you don't like it if people interrupt, but my property taxes for where I live are about $11,000 a year.
$10,000.
I know the answer, but I was showing everybody.
Yeah. Yeah. So it's really, so in our situation, with our state withholding and our property taxes, we're losing a big deduction on our tax return. Okay.
Right.
That's, yep. And that's, if you remember, last year at Christmas time, there was the mad rush. Can I prepay my county tax? Can I not? That's what it was for because of this SALT deduction. So, and they were able to do it. And actually, nobody knew it. It wasn't publicized. It was not. This year, all the counties could have created a charitable trust. You had until, it was the beginning
October 15th.
Yeah, October 15th, no, September 15th. If they would have created a charitable trust, you could have paid your taxes through the charitable trust, and it would have been able to been used as charity. But no counties in New York, at least in this area, did it. I called Niagara County, I called Erie County, and I called Genesee County. None of them did it. So it's really sad. Well, our taxes on our house are $11,000. We could have paid the $11,000 inside that trust and wrote off that $11,000 as charity instead of property
that's not
taxes.
capped.
Now they're gone.
Yep.
And the thing is, what's going to happen is it's going to take these counties and in the state of New York time to catch up with what the federal government is doing. As a matter of fact, the state of New York and New Jersey, And I think California has already filed a lawsuit against the federal government because they feel that it's disproportionately affecting high-tax states where the people had no choice, except they live here.
At that seminar we just went to, it says it takes about 3 years for the answer to roll out from the court case, though, so it's going to take time.
So there may be a lot of amended returns if they're successful in court to go back and do this. So even though it sounds like this may not be deductible and it may end up being deductible, last year when they first wrote the law, there were things that I thought weren't going to be deductible, like, for instance, employee business expenses. They just came out last week and said they are deductible because this is such a sweeping tax reform until they actually put it in the regs in writing so that all the details are done. You don't know exactly yet, so it may end up being deductible later.
And to reiterate for our employees, it's not for W-2 people. She's talking about business owners.
Yeah, right.
Business
Okay.
owners.
So, no, that's good because
I knew where you were headed.
that's the next part of this slide. This is one of the biggest impacts on the itemized form is no more employee expenses, no union dues, okay? No mileage. So what that means is if I have my personal car and I'm going from our main office and then I have to drive to our West Seneca office and then drive to Fredonia and drive back to our corporate office, those mileage, if Esther wouldn't reimburse me, would
I
be
won't.
in the old law, would be deductible on the tax return at 54.5 cents a mile.
But I think somebody's going to take them to court on that.
Right, but right now,
Right.
it's not deductible. So if I drive 1,000 miles a week for my job, I have $545 a week I could write off on my taxes. Multiply that by 52, as I put,
$7,000.
that's a $27,000 write-off on my taxes I don't have anymore. So that $27,000, if I was in the 15% bracket, is $4,200.
But how is it fair that a small business can write it off and I can't?
Right, and that's where
That's why they're going to.
that's why it's going to go to court, because businesses can write it off. Esther can write off if she pays me the mileage, she can write it off. But I can't as an employee if she says, you're on your own. Okay? So, I mean, that's a big thing. Over-the-road truckers, we're all on the thruway, right? And you see those big semi-trucks? Most of them are employees. They get what's called a per diem. Anywhere from $57 up to $94 a day they get to write off under the old law. New law, gone.
And they say truckers help to move America.
They move America,
However, I can see that employers are getting smarter because there is a workaround that they can do.
Right, that's what
sorry.
we're suggesting to our clients, go to your boss. So I'm going to go to Esther. John, follow me. Esther, and this is going to sound like I'm crazy, I'm loco. Give me a $10,000 pay cut. Right now, you guys are all probably going, what? But reimburse me for my expenses up to that $10,000.
So then Chris takes a $10,000 pay cut. I give him the $10,000 for expenses. Still got the $10,000.
I'm 100%.
Right, he's 100%. I get to take the $10,000 on my return. He saves FICA of 15.3% plus income taxes. So he's going to save about $4,000 taking a $10,000 pay cut.
And she's
but
gonna
getting
save
the same
money, too.
amount of money.
And I got to say, it sounds wonderful, but I have told this to client after client after client, and this isn't even my water, I don't know whose this is, but not one client's employer has taken advantage of it because change is very hard. Not one employer I have seen has done this.
Right. So that's
However, I heard a commercial the other day from a trucking company that said, whether you know you should come work, should come work for Acme Trucking, because you can't take your over-the-road expenses for anybody else, but we have a workaround. And I thought, yes, that's finally, so it'll take a while for people to get used to it.
So, I mean, so union dues, cell phone, okay? Continuing educations, we have to take 24 continuing education credit hours a year to keep up our enrolled agents. We were used to be able to write that off as employees, not anymore. Nurses, doctors, malpractice insurance, if they're employees, can't write that off anymore, okay? Tax prep fees, that was its own separate line on the Schedule A. Can't write that off anymore.
Financial
That's what I was
planners.
just going to say. Your financial planner, you know, where they charge you 1% a year of your net worth, and you used to be able to write that off, not anymore. I mean, that's a big expense. I've seen people, $13,000 they pay their financial person. I mean, that's a big thing.
Office and home.
Office and home for employees, gifts, meals and entertainment. Now, again, these are all for employees. My boss can still write them off. I can't as an employee. Is that fair? No. So you got to, gambling, gambling that was the next thing. It's not on these slides, but gambling is its own separate area on the itemized deductions. It goes on page 1, right? The income goes on page 1. The deduction, your losses, you have to be able to itemize. Well, 2 things. First of all, let's talk, what did they do to the standard deduction?
Increased it.
They increased it. So in order to claim your gambling losses, you have to be able to itemize. Right? So now you have a married couple, their standard deduction is $24,000 if they're over 65. It's now going to be $28,750 or somewhere, or $28,000, somewhere around there. If they only won $5,000 at the casino, and their other itemized deductions totaled $13,000 before, because of charity and everything else, and now you add in that $5,000, are they going to be able to use it to offset their income? No, because their standard deduction is $24,000, so they lose. You know, the other aspect now, say you're got really lucky at the casino, and I know I talked to a gentleman this week, and he goes, one day at a casino, I was at this one machine, and I won $5,000, and that was at a quarter machine, and I was betting 50 cents. So then I said, I have this money, so I went to a dollar machine, and after 4 hits, I hit for $10,000. He goes, so now they had to call their big shots down, it's taken time. So I go to a $5 machine. And first I'm going, holy cow. I would be having heart attacks putting in that money. But he put in the money. He won another $5,000. He walked out of that casino with $20,000. Let me tell you do you want to know what his losses were after he won all that money? He claimed all the losses, because every other time he went back into the casino, he lost it all. But now that $20,000, is he probably going to be able to itemize? Probably, because with the state property taxes and charity, it will benefit him a little, okay? The big change with gambling, you now can take your transportation. So you can take, if you go to Vegas or Atlantic City, okay, you now can take your airfare, you can take your hotel, your tolls, your mileage. They're letting you take your transportation and your stay, because they know that's almost the number 1 source of entertainment for people right now is gambling. I hate to say that, but there wouldn't be casinos every other corner along the way You know, I mean, I know I go to New York City. My daughter, who was just here, goes to school in Long Island. I can't tell you how many casinos we pass, right? And are casinos in it for you guys to win 100% of the time? No, they're in it to make money, so you lose. So you got, I mean, the government's giving you a little bit there as a windfall. Okay. Let's see, what else did they change? I think that's right, pretty much.
Yeah. Oh, well, there's 450 form changes.
Yep.
Oh, I know.
Oh, the postcard.
And the half sheet of paper. Remember President Trump wanted a half sheet of paper? He got a half sheet of paper, okay? But it's like getting a car with no engine. So the half sheet of paper only works if you attach up to 6 other sheets of paper and the forms to make it work. So he's got the half sheet of paper, but it ends up to be like an extra 8 sheets of paper.
So you now have this, what you're filing, okay? A half sheet of paper. But when you're all done,
It looks like
you
that.
have this. So
Because in order for the half sheet of paper to work, there's another form that says what you're withholding. There's another form that says what's your other income. There's another form that says what's your credits. So, and under those forms, you have to attach other forms. So it ends up to be a half sheet of paper with like 10 extra sheets of paper. So, you know,
it's not good.
be careful what you wish for.
Yep. I mean, I know I had a guy just yesterday, and all my stories are true. My employees can attest to it. Gentleman calls yesterday at 4 o'clock. He goes, I sold land, not my residence. How do I report it on my tax return? Now remember, Monday is extension deadline day. Okay, so I know what he was doing. He was doing his taxes. He waited to the last minute. He goes, I was reading, do I just put it on a 4797? I said, that's where you start. And he goes, what? I go, you need a Schedule D then. I do. He goes, well, where do I pay 28%? What tax rate do I pay on it? You pay the capital gains rate. Well, how do I do that? Well, you got to do the Schedule D tax worksheet. But how do I do that? And I wanted to say, get your butt into my office and I'll show you how to do it. You know, but he was ready to pay 28% on an extra $10,000 of income, where his capital gains rate might have been 0 because of what his income was. You know, and I was really nice trying to help him over the phone. But, you know, taxes are getting, as much as they say they're getting simpler, they're getting more and more complicated. So you got to be very careful. You know, if you're a do-it-yourselfer, have a professional look it over. We look it over them for free. We have people come in during tax season and say, did I do this right? And we'll, yep, you did it fine. If you did it wrong, we'll say you did it wrong. You could get an extra $3,000 back and they'll, oh, well, can you do that for me? Sure, and we'll do it for you. We'll charge you, but we'll do it for you. We're nice, okay? So
Ask how many, anybody here with rental property? You have rental property. So that's what I'm going to deal with when I do the 1245 business things, because business presentation, because for you, there's the pass-through deduction. So that's really complicated. So business owners, people with rental property, people with real estate investment trusts, there's a brand new substantial tax break for you.
yeah. And
Depreciation.
just for those with rental properties, Esther brought it up, the next presentation in room B is Russ Gullo, okay? He's going to tell you how to pay no tax on that rental property when you sell it. Okay, can I mention your brother?
Yeah.
Okay. Esther's brother, just so you know, had 15 rental properties in Florida, or in Michigan. He's now lives in Florida. Kind of hard to manage 15 rental properties when you're 2,000 miles away, right? So he just did an exchange for all his rental properties in Michigan, bought one property in Florida, one rental property. He saved $70,000 in taxes.
Defer.
Die.
Right.
That's, by the way, that's Esther's motto: defer, 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 die. Don't pay taxes, die, and you let other people worry about it.
No, because when you die, it's a really happy event because your children get your capital assets at a stepped-up basis. So let's say, like, for instance, my brother, he had all these properties. Had he died before he, I'm glad he's alive and everything, but had he died and his kids got it, they wouldn't have paid the $70,000 in taxes because they would have gotten a stepped-up basis at the fair market value of the date of his death. And if they would have sold them, they would have paid zero. So dying, if you can plan it properly, means your estate really makes out very well. But my brother wanted to continue living, so what can you do? Many times I thought of killing him.
And the next one in this room is Jeff Katz, who's going to talk about estate planning.
Right.
Okay? So all our presenters here are basically people that will impact your tax return.
And your finances.
And your finances, okay? There's a ton of information to be learned here, okay? Even the Medicare and the marketplace, because health insurance, at least for 2018, still impacts your tax return, okay? Actually, it will for 19 if you're on the marketplace and you get a subsidy. It still goes on your tax return, because your subsidy is based upon what your projected income is, okay? And that's where that comes into play. Say you have a couple who's 40 years old, and they say, oh, our income is only going to be $30,000 this year. Now, you have to predict your income in October, so we'll say now, for your 2019 income. How many of you have crystal balls? I know there's some people out there who may have crystal balls. But we don't know what the future is going to hold, right? So these people have to project, well, based upon years past, I'm going to say $40,000, okay? So the government's going to go in and say, well, based upon $40,000, we're going to give you, and I'm using this as an example, $700 a month to help you pay for your health insurance. Okay, so 700 times 12 is what? $8,400. Okay, when they file their tax return now in 2020, right? We'll say in February 2020 for the 2019 return, they have to prove to the government what their income was. So if once we do their tax return, say they were one of those lucky people who won $20,000 at the casino. Now what's their income? 60,000, right? Well, that subsidy that was $700 a month may now only be $300 a month. So that extra $400 the government gave them per month, they have to pay back on their tax return. So that's how health insurance impacts your tax return. I mean, it's crazy. But, I mean, I am done. If you guys want any private sessions, Esther, myself, Tiffany's available. We will go in the back room here.
Or they could just raise their hand.
Yeah, is there any questions before we break up? Yes.
What about charitable contributions?
Okay, so there's no change on the Schedule A except for the state and local income tax and the miscellaneous business expense. So your medical's still the same, your charity's still the same, taxes are capped at $10,000, mortgage interest is the same provided you used it for acquisition or remodeling, okay, up to $1 million. I don't think
charity, though, did go up to 60% of your income.
Right, but charity is still going to be deductible. The difference is, though, until you can come up to that cap, you may not be able to use it because your standard deduction might be higher, but on the state of New York, you may be able to itemize. okay?
Okay, and, sorry, speaking of charity, I see a lot of seniors in this room. Take advantage of doing the charitable distribution through your IRA. Yep, that is still in the law. So you know that minimum distribution I was saying earlier, that $4,000? You could send that directly from your IRA to your church, to
Boys and Girls
Boys
Club.
and Girls Club, LOL, whatever charitable organization you want. And that doesn't go on your tax return, but you took out your minimum distribution. Okay? So that's a big thing. What that, there's two things. Okay? First of all, your Social Security depends on, the taxability of it, it depends on all your other income. So if you have to report that extra money, your minimum distribution, that can make your Social Security taxable, or a lot more of it taxable. So by doing the charitable giving through your IRA, you're keeping your income down and keeping then your taxable Social Security down. The other thing is, by keeping your income down, it helps with the enhanced STAR, right, for seniors. It also helps with Medicare. Okay, I just got a couple really puzzled looks. What do I mean by that? Social Security, you know how it's the $134 now comes out of each check for Medicare? That's based upon your income. So as your income goes up, your Medicare's gonna go up. There's no cap on it. I don't have the figures in front of me, but it can go, I've seen someone pay $370 a month.
And that's a new law, right?
And that's a couple years. Yep. $498 a month for Medicare. So imagine now, if you're only getting $800 a month in Social Security and $500, because some freak thing happened, you know, maybe mom died at 100 and she still had a lot of money in her IRA and you did the wrong thing and took it all out. Well, that just made your income go up to make you pay more in Medicare. So you got to be really careful. Yep, it's a year-to-year basis. And you can, if it's like that situation with mom dying and you got her pension and you didn't know, bad financial advice, whatever, you can fight it with Social Security. I think there's a pretty good percentage that you will win, that they'll keep it down.
And we can help you with that.
Yeah,
We've written
Tim,
letters.
and yeah, we've helped people. So you just be careful with it, you know, with income. Any other questions? That raises your income for the enhanced STAR.
Okay, so it is included.
Yep. Yeah. Okay, the question was, what happens if I take money out of my 457B in regards to the enhanced STAR? That goes on your pension line, which is income according to STAR regulations.
New friends, new opportunities, new partners.